big week here, $1 billion deal and a new PE sponsor in commerce enablement, and big news for us. Welcome back to the Inorganic Podcast. It's Market and Deals Friday. Before we get into the content, Ayelet, happy 30th birthday. How are things in LA?
You just announced to everyone that I turned 30. That's not that nice, but my birthday was great. I had an amazing time, except for the fact that I woke up on my 30th and my back already hurt. So that's not something I'm looking forward to in my now old age.
Good news, you don't look a day over 29. Bad news, your back pains are just going to get worse if my own experience is anything to guide you.
That sucks for me. But something that's actually exciting, instead of talking about my old age, we have big news. As of this week, the Inorganic Podcast is officially part of the Marketecture Media Network. So Marketecture is a new way to get smart about advertising, marketing, and now commerce. The network is a team of industry practitioners that helps you understand the complex world of commerce and media through newsletters and podcasts, interviews, events, and we're thrilled to join the platform. Huge thank you to Ari, Jeremy, and Sam for bringing us on.
And another first for us, the show has its first official sponsor as of this episode, Sifted Pro at sifted.eu. It's a great sponsor for us because Europe has some really great startups that are highly attractive M&A targets, but it's not easy finding them. Sifted is a great way to identify both partners and acquisition candidates that can help build out the tech layer to set your business apart or fill gaps in your product roadmap. Ayelet and I are super excited to have them as a partner. Okay, so today we have one feature that's a bit of a personal story, $1 billion exit in commerce, another deal in the 500 deals of 2026 Ayelet and I keep talking about, but there are two headlines underneath the deal you should be taking notice of. One, the new private equity sponsor in commerce enablement, as I mentioned a moment ago. That means more M&A. And two, it's a signal that it's not all doom and gloom for software companies that are the pre-2022 vintage. So those are the two quick hits. Let's get into the headline. On July 22nd, Salsify, a Boston-based product experience management platform, announced that it is being acquired by Cinven, a European private equity firm with about $50 billion in assets under management. Quick read for our listeners. Product experience management, in simple terms, is where a brand organizes all of its product information, its images, descriptions, length, width, height, ingredients, and gets it nice and pretty to be syndicated to Amazon, Walmart, Whole Foods, Target, wherever you are going to look at it on your phone or on your screen. Salsify defined a category of syndication capability to make it possible for brands to do that really easily. And they're arguably one of the two most significant players in this category. So the deal is signed and pending closing, subject to regulatory approval. Salsify is a US-based company with operations in the UK, Portugal, France, and Australia. The approval should be fairly clean. We're in a regime that doesn't really like to get in the middle of mergers and acquisitions, so this should close in 90 days or less. On the terms, there have been a ton of questions. They are unofficially not disclosed, but as a practical matter, management announced the deal on Wednesday morning to the employees of the company, for which there are several hundred, and the news is circulating around the alumni network as it is approximately a $1 billion all-cash deal. I believe that based on some back channeling I've done. If that's true, that would be a 50% haircut to Salsify's 2022 Series F mark, which was when TPG and Primera invested at about $27 a share. So depending on the deal waterfall, that could mean roughly $13 to $14 per share if you're doing simple math. And a lot of former employee alumni friends have said, well, what does that mean to me? If you have 1,000 common shares and the company's announced the value internally you probably can safely bet that the math is $13 or $14 times the number of shares that you own. And we'll talk about cashless exercise a little later. Moelis and Company ran the sell side for Salsify, led by Xiaojing Zhang, a highly reputable banker in commerce and ad tech. There's no corporate development at Salsify, so management principally working with Moelis on the deal. Just a program note for our listeners, I was not on the buy or sell side or directly advising anyone on this transaction.
Pretty crazy. And you being so close to this, obviously not officially advising, but there's so much back channel going on. Let's take it back for a second. Help me understand the people piece of this. Like, who are the people behind Salsify and how did it become what it is today?
Great question. Glad you asked. As I mentioned at the top, it's a little bit of a personal story. I've been close to this business since its founding. Jason Purcell, Rob Gonzalez, and Jeremy Redburn were the three co-founders of this business. They're ex-Endeca. Endeca has created a lot of great SaaS companies in Boston over the years. Toast is notably one of them. Co-founders started Salsify in a shoebox office in Chinatown in 2012. It really is hilarious to go back and think to where all this started. And I was been fortunate to have known the founders since that time, and they offered me one of the first sales leadership jobs in the business. I will probably question whether I should have taken that until my death. But look, 14 years later, they've built a 160, 170 million ARR business. And that brings me to another important acknowledgement, which is the people. Jason was the CEO, was especially concerned about culture, having come from Endeca and not had a great experience there. And so he was very intentional about building culture, nearly to a fault at times, I would say, in my own opinion. But he built this Salsifarian brat pack. And if you worked at Salsify, you knew that you went through a very, very picky hiring process. They hired on culture, they hired on intellect, they hired on your ability to be autonomous and get things done. And what that created was not just a great team internally, especially in the early days, but as people moved on from Salsify, they brought with them others that they had worked with. I have a lot of revenue guys that have been working together through 3 or 4 different companies, and they've even brought me into some companies in my career. So it's a really cool gang affiliation that is highly unusual, and it's a special part of the story here is the people along the way that made Salsify what it is. I think the other thing that needs to be appreciated and mentioned is the customers and the community that have been built around Salsify. The Digital Shelf Institute, which was co-founded by Rob, the co-founder Peter Crosby, and Molly Chantal was an early contributor to what was called the Executive Forum. This is now led by Lauren Levac. This community is a big value piece in my view of this enterprise, and I talked about it on the CPG Guys podcast. That community is worth at least half of what Cinven paid. Every acquisition that they do from this point on is going to be worth double the day of closing because of this community. It's essentially customers who treat Salsify as non-optional. And when B2B companies try to build communities, this is the pinnacle of what they try to create. So full stop, the people are a very important part of the story.
I love the people piece of it, obviously, because that's a lot of what I got from the deal architect standpoint. But let's get into the operator's read on the deal. And for our listeners, just some context. Christian and I do both the operator read and the deal architect read on every deal. From the operator's read on Christian's part, he'll talk through like the strategic value, the deal price, the comms strategy, and the post-merger integration risk. So let's start with the strategic value here. Cinven is not a known PE in the commerce space. This is a very big splash into it. So what does that tell us about this deal and the strategic value that they're going to bring to Salsify?
Yeah, exactly right. This is a new investor in commerce, and it's going to shake things up a bit. Existing sponsors who are material in commerce include Advent, Summit, the Jordan Company, Thomas H. Lee, Thoma Bravo, Insight, and these established players are heavily invested, I would almost say tapped out, with substantial positions in companies like Rhythm, Syndigo, Bazaar Voice, InRiver, and they couldn't make another bet here. So we needed a new strategic PE with a large capital position, and Cinven is taking that seat. I was surprised to not see KKR or GTCR jumping on this because of the M&A potential, but maybe the opportunity wasn't big enough. Those investors like, multi-billion-dollar objects. That said, the value that Cinven brings to the table, number one, in my view, is its European base. Salsify's weakest area has always been inorganic investment. They always kind of erred on the side of we can build it better than anyone else. And I think that was many times to a fault. But in Europe, there is a lot of M&A opportunity for Salsify, and Cinven's country-by-country network, plus their family office, investor, founder relationships in the region are going to be able to bring these M&A opportunities to Salsify much more quickly and efficiently than you could from U.S. soil. And European M&A is its own animal. A U.S. firm would have a harder time running that expansion play, I believe. Bottom line, a PE firm based in Europe will give this company an edge when it comes to inorganic, which is absolutely what PE underwrites as a part of their value creation plan.
Speaking of Europe, the EU has some great startups, like we were just saying, that are highly attractive M&A targets, but it is not always easy to find them. And I get asked all the time, how do you find deals and targets? And one of my tools for sourcing acquisition candidates is Sifted Pro. Sifted is a great way to identify both partners and acquisition candidates that can help build out the tech layer to set your business apart or fill gaps in your product roadmap. So check out our sponsor, Sifted Pro, at sifted.eu. Now, let's get back into the deal and the deal price, because you've some interesting pieces to this. You make it sound like wildly successful and how excited you are, but you also said it's a 50% haircut to their 2022 valuation. So do you think that you're just biased because of your history and their great job of cult-like marketing with the company, or do you think that it's actually a success story?
I'm totally biased. I mean, are you kidding me? Absolutely. This company has been like a second language to me for more than a decade, and it's responsible for, several of the successes in my career. So let's just call a spade, but on the facts, this company, to be fair, had a chance to go public. It probably could have, but market and I think some operating paper cuts got in the way, and it's a fair criticism to say that that is the case. However, we're in a market right now where there are some not great outcomes and some SaaS companies that are way, way worse off. And the AI risk flags on this deal were probably not de minimis, so they clearly passed. If we go back to that billion-dollar all-cash headline, the company probably had some significant cash on hand as well, which helped inform the value of the deal. But on the headline, I would guess this is about a 5x trade. And a 5x trade in a market where 3 to 4x is considered top of market right now for non-AI software, in the 2025 M&A software medium is 2.6x. So 5 should be seen as nothing more than a great outcome. Definitely not a fire sale by any measure.
You brought up Syndigo a minute ago. Where were they in this? Where were the other strategics? Where was Salesforce and SAP or Oracle or the other ones?
This is the question that I get from all of the alumni, and I've been asked this time and time again over the years. Christian, who picks this up? Who picks this up? So there's mud in my face on this because I took a very strong position from the very beginning that a strategic like SAP, Oracle, or along those lines should have been pounding the table for this company. On the question you asked, Syndigo probably wanted this really badly because it is the number one competitor, and it's probably not material enough for the FTC to want to litigate two major competitors like this coming together, but they just paid $1.2 billion for One World Sync, and they're very heavily levered already. So the financing would have taken months, and I don't think this process had months. NIQ is another material player that probably would have been interested, but their stock price has taken a beating over the last few months, and cash on hand would have struggled to finance this kind of a deal. So the strategic who should have been at the table was SAP. I will be mystified for a long time why SAP's CEO wasn't frontline on this deal and, trying to get something done. Salsify's attach rate to SAP Hybris, which is now a sunset product. It's an enterprise data management engine that pretty much a lot of the Salsify customers use upstream from Salsify. That industrial logic is a no-brainer. On top of that, enterprises like SAP are moving down market, and Salsify already spans everything from the absolute global enterprises into mid-market. So, in my opinion, SAP should have been at the table and paying up. They were not. I think if I'm, again, being critical about why this didn't happen, a great comm strategy in a sell-side process requires having strategics nailed down quarters before coming to market. The bed is made here sometimes well before the sell-side banker shows up. And what investments are made in partnerships is a question. B2B companies broadly love to underappreciate the future of strategic partners and overinvest in the wrong ones or not be in the right places at the right time. It's a bit of an epidemic. It's hard because it's like, oh, well, 3 years ago, we changed the way we partner with companies because we don't want to spend money here. We want to spend money there. Well, it comes and bites you later on when you're coming to market and you don't have the tight relationships you need to get a strategic exit. So my prediction is when this trades again in 5 years, I'm going to guess that Cinven is going to have a much more strategic positioning with the likes of SAP, and they're going to have to pay up for what they passed on in this round.
Yeah, you heard it here first for your prediction on that one. Big bet right there. But going back for a second, because you've talked about this in the past too, that there are not a lot of operators in sell-side banking. And so going to the value of what a banker brings in a process is two different things. One, it's obviously like the relationships with the right buyer, but it's really also about communicating the value of the business, both now as well as what it would look like to the buyer post-close. But from an operating lens, it would have been really interesting to see what would have come to the table if there was an operator inside this process. You've talked a lot about people over and over and over again. You've mentioned it 100 times. So I know what you think in this then. But in your own words, what is the post-merger integration risk? Like, what has to go right? What could go wrong? What's your take?
You said two things there. I think we could have a whole episode on the importance of operator in investment banking and in PE for the exact reason that you mentioned. So we'll have to table that in the interest of the length of this episode. But PMI here is mostly the people, as I mentioned earlier, and we're not bringing two companies together. This is a new owner. The good news, if you're currently inside of Salsify, European PEs tend to be quite conservative when it comes to people. They don't really like to break things. CEO Piyush is a solid, and he's probably hard for them to want to swap. He's done exactly the job that he signed up to do. And generally speaking, the leadership team that is in place right now has gotten the company to where it is. And I think they've done a great job. There might be a couple of people who are going to have a big payday, and the bigger problem is going to be retaining them after nearly a decade of a lot of hard work, a lot of long days. But the signal that I take away from, again, the kind of the internal messaging to the team that was shared in the employee all hands, and this is second-hand information to me, as I alluded to earlier, but I think a real great signal is employees who have not exercised options, they are going to allow them to do a cashless exercise so they can get the full value of their vested equity. And that is a real sign of the PE starting on a really strong positive footing with the employee base. And I think that's a play that any PE should want to do. They don't always do that. A lot of PEs like to take that unexercised equity off the table and, call it a day and call it, a part of the deal. But that is a way to really hammer home on day one the kind of partnership you're building below the press lines. The other thing that Cinven's going to be able to do here that's going to really ignite the excitement in the team is don't take any time starting on the M&A. It's no secret that this are very excited about M&A and seeing M&A happens. It creates a lot of excitement around the growth and the expansion of the business. So if I'm in Cinven's shoes, I'm on the phone with anybody who is an expert in commerce M&A.
So is your phone ringing?
Oh, it could be.
Okay, so let's get into the deal architect lens of this deal. And so this is a lot about where I look at the people and the behaviors and also how that translates into both the deals in the outcomes.
What does the press release tell you how the P and management work together?
The press release, to me, it sounded a lot around like a lot of mutual alignment. So management and Cinven, they sound aligned on the go forward. It reads a lot like a partnership, not a takeover. We know that it is a tough market right now. And so a clean all cash deal with the team intact and a war chest is a win that the shareholders should be definitely happy about. The mutual alignment is really interesting, though, to see how they can handle the value that the community piece of it holds. You talked a lot about the community, and community is a different asset class. We know that community is a premium asset right now within the AI era. We see a lot of deal flow on the marketing services side that lean heavily into experiential. So we know the value, and there is going to be a lot of value if they can properly leverage their M&A strategy with the community piece of it. But you can't just, assign the IP. It's a very different breed because the value lives in the people and the trust going around it. And so I've seen multiple companies that have not been able to transfer ownership of people-driven communities. And so in order to really keep it going post-acquisition, it's going to take a lot of retention, and that holds real risk. Christian, what were you going to say? Because I have a question for you too.
Well, what I was going to say was what some financial buyers do. I'll let them name nameless. Is they run a playbook, and what they do is they try to monetize the community to its detriment. They try to start creating membership levels and getting fancy with heavy sponsorships. The Digital Shelf Institute has the Digital Shelf Summit annually, and it is a revenue producing conference, but it's also a lot about building that community. Well, one way to take it is too far, where you start over monetizing it and run the risk of eroding the value or making it feel a little cheap. So TBD on whether that happens or not here. I'd be surprised if they did, but I don't think this is the kind of buyer that does that. But that's a risk I've seen play out in the past.
But are they even going to value the community in the same way? I mean, this is a European financial buyer. Are they going to view it differently, potentially?
If I'm evaluating this deal and I'm thinking about de-risking, the community actually was a significant way of de-risking retention. You look at GRNR, I'm confident that several basis points of GRNR are positively impacted by the existence of the community, and the investors would be remiss if that wasn't a part of their calculus.
Interesting. Let's wrap this. We've been going on and on about this. Tell us your final thoughts on what this potentially means for the market and for M&A in general.
Number one, Syndigo has a real rival, meaning Salsify is now capitalized with a partner who will do intentional M&A. And these companies are real rivals. That rivalry is now going to take itself to the M&A street. And the downstream impact of that is both of these players are going to be picking up 5 to 15 million ARR companies to batten down their hatches and get them modernized more credibly for the AI era. So I expect commerce M&A in around these companies to light up as soon as closing. So as you said, we've covered a lot of territory here. Why don't we get into the quick deal hits?
Yep. First quick hit is Tracksuit, which is a New Zealand brand tracking company, bought Hall, a Sydney startup that measures how brands show up in AI answers like chat and Claude. They're adding AI visibility to old school brand tracking. Terms were undisclosed, and the team comes along with it. This was a small tuck-in acquisition here. Second quick hit, Neon, a startup building the commerce and payment stack for video game publishers, raised a $13 million Series A round. The round was co-led by A16Z and Renegade Partners, with Crafton as a strategic investor and customer. The pitch was that this gives publishers their own D2C stores so they can bypass Apple and Google's 30% App Store tax.
Ouch.
Ouch. Yeah. Everyone's trying to route around the App Store tax. So it is definitely a commerce infrastructure land grab, and they've raised $27 million to date. So that is it for the two quick deal hits. And just to wrap the episode, I want to just tease what we're going to be talking about next week. The report that just came out from Everose and Adweek, which is their sentiment report. And make sure that you tune in for that, because it talks a lot about the realities that we're living in when it comes to M&A and what we're seeing from a real POV too.
Cool. Well, thanks for joining us for Market and Deals Friday. Again, now proudly part of the Marketecture Media Network. And thanks again to our sponsor, Sifted Pro. Subscribe to the podcast on YouTube or leave a review wherever you listen to podcasts. It helps others find us. Have a great weekend.